Hey there, allow me to walk you through our tax-free distribution design. And in this design, I'm using a 46-year-old male, standard non-tobacco user out of the state of Florida. So when we get this thing started, we can start the comparison with a $20 million term insurance policy for 10 years, 20 years, or 30 years. And we can see the respective premiums. The 10-year premium is $22,000 a year. The 20-year premium is $38,000 a year. And the 30-year premium is $70,000 a year for 30 years. So that'd be paying $2.1 million in premium payments. And statistically, there's a stat out there that says less than 2% of all term insurance policies ever written since the beginning of the history of term insurance policies have ever paid a death claim, meaning 98% of all term insurance policies that are started are not in force when it's time to pay the death claim, either due to the fact that the term ran out, so they had a 10-year and they were still alive at the end of 10, 20, or 30 years, or the insured canceled the design, canceled the policy. So term insurance is really a moneymaker for the insurance carriers, and it doesn't really cover, unless it's a very specific window of time, it doesn't really cover what you need because you never know when you're going to pass away. So then we have permanent policies. Permanent policies consist of indexed universal life, whole life, and variable life. And from a $20 million design, in order to put enough premium in to match the tax-free distribution that we're able to get from our design, whole life policy would require nearly $1 million a year for 10 years. So nearly $10 million of premiums going in over the 10-year period of time. For a indexed universal life policy, it's $500,000 a year, $520,000 a year for 10 years. So $5.2 million of premium payments. And for a variable life policy, just shy of $500,000 a year, but you don't have the guarantees or the safety net that index UL or whole life would provide. So most people choose to go with indexed universal life. It gives you a benefit of having a fixed product with upside potential. So it's kind of like the whole life. It's kind of like a variable life, kind of smash them together. And that's where you get indexed universal life. But our design is unique in the sense that we are going to introduce bank financing to pay those premiums. And we only show this particular client paying $135,000 a year for 10 years out of pocket. Now, when banks loan money, they want two things. Banks want interest and they want collateral. So when we're financing this policy to its maximum possible potential, the illustration software for this carrier suggests $1.3 million a year for 10 years to maximum efficient, putting as many dollars in as possible to maintain the tax-deferred, tax-free status that the IRS affords. We show our client paying 10% of that number out of pocket, $135,000 a year. So columns 3, 4, 5, 6, and 7 are straight from the insurance carrier. Policy premiums for 10 years, policy value, cash value, that's the portion of the policy value that the bank is able to take a lien on for liquidity purposes. They could liquidate, and this is the amount of money they would get upon liquidation. And then the gross death benefit of the design, starting at $20 million. Columns 8, 9, 10, 11, 12, 13 is bank financing information, bank borrowing information. So we're going to borrow exactly the premiums that the insurance carrier is requesting over the 10-year period. We're assuming interest rates will be about 5.6% for the next 12 months, maybe going down another 50, 75 basis points. It's already happening. And then we leave it static at 4.5%. And then we show the policy crediting 6.5%. So we're showing a 2% or a 200 basis point differential spread arbitrage between the crediting of the policy and the cost of borrowing the funds. This does not mean your policy will earn 6.5%. That's just what we're limited in showing. Historically, this product is averaging closer to a 10% return over the last 15, 20 years, but we can only show 6.5% due to industry regulations. So paying $135,000 out of pocket for 10 years, that is a negotiable number. That is a number you can make a decision on each and every year. You're not committed to that number. It's a projection, not a forced payment like a mortgage. What you pay in column 12 has a direct impact on collateral in column 14. And collateral in column 14 is calculated by taking the end of year loan balance minus the cash surrender value in that year, column 6, minus the payment made out of pocket in column 12 equals column 14. And it's a placeholder. So it would be a cash equivalent, marketable security, standby letter of credit from your bank against a real asset or a hard asset, or a pledge of a brokerage account through a control agreement where those assets stayed invested, but they're tied to this from a collateral standpoint. We project that based on these numbers, conservative numbers, $660,000 is what the collateral would start year one. And then due to the performance of the vehicle, we expect that to go down relative to the cost of borrowing. We can model this out. We already feel like this is fairly conservative, but if we need to be even more conservative, we could. We cannot be more aggressive. This is as aggressive as we can get. So at the end of 7 years, you're out of the collateral pledging business, which means that the cash surrender value of your product, your policy, is larger than the outstanding loan balance that the bank has. And this is a no personal guarantee, no corporate guarantee, non-recourse loan. So this outstanding loan balance, you have no recourse against. The only exposure you would have is column 14 in this design and your ability to pledge that. Now, this design is an income design or a tax-free distribution design. So instead of just letting the death benefit accrue, we start taking distributions from this design in year 16 of $511,000 a year, income tax-free, right? So depending on the state, in the state of Florida, that's probably closer to $850,000 of the pre-tax earnings to pay the tax to net the 511. But we're showing you taking that every single year for the rest of your life. And we ran this all the way out to age 118, 119. And you can see the death benefit, column 15 over here, is the net death benefit. In the early years, it's the net death benefit after the loan is repaid. And once the loan is out, it's just the death benefit that your beneficiaries would receive. Pretty substantial design. And again, this is based off of a $20 million policy. So if we need to go 10 million, basically cut these numbers in half, all of these numbers in half. If we were to go 40 million, multiply these numbers by 2, 50 million by 2.5. We can help in whichever direction we need to go to customize your bespoke insurance designer